But if we can get through the month of September, then there's macroeconomic reasons to think that gold is going to do quite well, and that includes the India festival and wedding season. So that's a time that the gold market generally goes up to begin with. And you follow that by you get a little lull in mid-October to mid-November, and then you've got the North American, let's say the Western world, love trade for Christmas, where demand for physical gold goes up again. So,
and we've got this theme going at the moment, sort of investment hacks for retail, high net worth, and family offices who don't have the experience that you do. And you gave some really nice clues as to the sorts of things you look for in terms of, in this case, the gold market. You're looking for Labor Day. You're looking for the Indian festival season. You're looking for the Christmas period. So these are little I don't know what you'd call them, little flags that you're looking for when you're thinking about investing in a specific commodity. Mm-hmm. What are the clues that you can sort of share with people in terms of things that you look for? Not necessarily the companies, but the things that you're looking for.
Well, I think you're looking generally to anticipate what the market's going to do. So we run a very contrarian philosophy. We try to get in early. We try to see trends that are happening. So I just gave you one. The gold miners have gone up, and the explorers and developers, to a lesser degree, there's specific stocks that have gone up, but for the most part, the juniors have not participated. Now, these companies do not have cash flow. They fund their operations through share dilution. So, but if you can buy those before if we are in a gold bull market, and I'm increasingly convinced we are, then you look for sweet spots within that market of things that have not reacted yet. And for me, that's the better gold explorers. This market is increasingly bifurcated between the haves and the have-nots. The haves are the ones you want. So there's, for instance, on the Toronto Venture Exchange, there's about 1,300 listed companies now. And this goes the gamut of commodities, but they're dominated by gold. And there's probably a couple of hundred good companies within that 1,300. And you go and look for the ones of those that have staying power, have good projects, good management, share structure, haven't moved up yet. And those are the ones you target.
So you talked a few things: a good share structure, good management. So you're following people who have done it before, made you money or made investors money. What's the structure of the company itself? Do they need to be above a certain market cap? Do they need to have a certain amount of cash in hand? What are the
cash
clues?
in hand is a very good point. Sorry to interrupt, but I know exactly where you're coming from there. And especially in a bear market, cash in hand, or the ability to raise cash without undue share dilution. And that's the bane of many juniors, is the inability to manage their share structure. But good companies do that, and they find alternative ways to raise money, perhaps with the business model. Small royalty companies, prospect generators. Those are a good niche in the market to take a look at. We've done quite well with a small prospect generator royalty company, Illegal Royalties. Picked that at 9 cents in February of 2018. I haven't looked over the last couple of days, but it reached an all-time high of 38 cents last week. So that's pretty good return in a year and a half. So you need to go out and find stocks that have not moved or have ability to move again. I still like Illegal Royalties, as it's being re-rated now as a junior royalty company versus prospect generator.
But there's the rub, really. There are lots of companies where the share price hasn't moved because it's never going to move.
That's true. Or
right?
maybe it's going further down.
Yeah. But I don't. What I'm trying to work out is what are these identifiers which you say actually they haven't moved. It should move. The fundamentals are good. They're strong. That's the one I'm going for. So
Yeah, so for me, being a geologist starts with a project. So I'm looking for generally advanced explorers projects in stable jurisdictions geopolitically. For me, that's increasingly focused on the Americas. Uh, Although I'm a early shareholder in one private company in a very geopolitically risky part of the world. Um, but a good project with potential, the right geologic environment, share structure. You want uh, management to have plenty of skin in the game so they are operating in all shareholders' best interest. Tight share structure management with skin in the game management has had success in this business before. I look for technical management, either geologists or engineers at this stage of exploration development of companies. And once again, cash or the ability to raise cash without
okay.
severe dilution.
So I take all that on board, and that they are things that people must look at and understand for sure. Management with skin in the game is one thing. Management who've put money in but pay themselves big salaries. Do you think they deserve big salaries because they've got a track record, or do you think they need to earn that?
Well,
What's
I
your
think you
take?
need to look at their salaries and make a decision on the stage of the project to begin with. So companies have done well and they're at the development permitting development stage. You can argue that those CEOs, those management teams deserve higher salaries. There's kind of an average median amount of dollars that CEOs, at least in the Toronto, Vancouver markets, that is, you look for anomalies within that. So if they're making way too much money compared to their peers, that would raise a red flag. If they're working for less than their peers and they've done well, that tells you that they're probably not running what we call a lifestyle company, where they take fees and salaries out of those companies and do not have success for the average shareholder. So there's some things to be aware of there.
Yeah, certainly. We've interviewed quite a few CEOs, and we've asked the question, and we get a very generic answer back, which was we pay ourselves the same as everyone else, without, and the information is publicly available. So I always encourage investors to go in and look at the paperwork, see if they're comfortable with it, and see if they think that's a fair distribution of their money for the type of reward or growth or value being created by the company. It's a really
Point
important one.
well taken there. And it is, that information is readily available through uh, notice of annual general meetings, uh, the the company's uh, the management and insiders cost basis for their shares or what they've paid for them. That's readily available. Commonly, one of the tricks they pull is they found the company and they vend a property into it that they have a vested interest in, and they reward themselves a bunch of shares for a penny or less. So you want to make, one of my common questions among CEOs is, what is your cost basis? How many shares do you own, and what's your overall cost basis? Another question would be, your last equity raise. Did you participate? Did you put money? How much? How many shares did you take? What percentage did you take? Did you continue to dilute yourself because you have shares that in total cost you a few pennies, and now you're doing a 50-cent financing or a dollar financing, why didn't you average up? Why didn't you participate?
Yeah, those are fantastic. They are fantastic, fantastic observations, and people must listen to this bit. If nothing else in this video, listen to that, because that is where the games are played and where retail can lose
Absolutely.
a lot of money. They can lose their shirt because that's a promotion game, I think a phrase you mentioned earlier. It's a
Yeah.
lifestyle company game,
Yep.
and these companies will not ever get into production because it's not the aim. The aim is to take big salaries and
Aim is to mine the stock market.
to mine the stock market. There you go, Mickey. Mine the
Now,
stock market.
it can be argued that we all mine the stock market. I mine the stock market.
There's,
I'm
but
not sitting
ethics.
around waiting for companies to become gold miners. I'm looking for increase in share price, and I'm a trader.
Yeah, no, I hear you, but I think everyone's got a different business model because you got to do what's right for you. But I think ethics should come into this. I'm not always sure it does. There we go.
And I think it's incumbent on the retail lay investor, and those are most of the people that are my subscribers. Um, that it's not go out and pick the stock that your brother-in-law told you was going to go to the moon. Do your own due diligence. Learn how to research these things. I mean,
Yeah,
you're playing with your money
yeah,
now. Hopefully, that's just discretionary funds that you can afford to lose. But you know, go out like you're shopping for a house or a car, and dig into this stuff before you put that capital on the table.
I agree.
And too many people don't do that. I have an opinion that people are human beings are inherently lazy, and I'm lazy. If I can find ways to shortcut decisions, I do that. But when it comes down to the bottom line, you know, this is money. This is your capital. These are your assets. This is what you want to pass on to your progeny, or is what going to buy you your second residence or third residence in some vacation location, if you will. So, so it's incumbent on people to research this stuff and not just roll the dice on these
Yeah,
companies.
when
You
we've
do that,
seen,
it's
yeah, it is
not going to work.
madness. It is madness. We've seen a lot of different types of investors over the past few months. There's some very diligent, hardworking, serious investors. There are others that perhaps, as you say, don't work as hard as they could or should, given it's their money. This is their money they're putting on the table. If you're not serious, it's just a bet. Go down to the bookies, as we call over here. Go bet on the horses
Yeah,
because your odds are
we
probably
we
better,
have bookies here too.
right? Okay,
That's what we call them here.
right. Okay, and we've seen a lot of people but what they all have in common is they all get very emotional because their money's involved. But some are going to win, and some are going to find it harder to win because they put different levels of effort in, and I think that's been a real revelation to certainly me because I've come from the institutional side to sort of see the way that people approach this game that we're playing.
And it really is a game, and it should be without emotion. Should make trades, should make financial decisions in the marketplace without emotion. There's three basic emotions in the stock market game, if you will: uh, uh, fear, greed, and panic. So let's start with greed. In a bull market, when everything is going up, people have greed, and because of that, they do not take profits. They do not sell. They think things are going to continue to go up and up. They get into things when the market is going up because of greed. They see, for instance, the gold market goes up. Oh, well, I have to go buy gold. Well, I bought gold a few months ago. I'm not buying gold today at a 6-year high. That's risky. And so and then on the other side, you have fear. So when markets go exponential, they will go down. The other side, they will go parabolic. So once the top is reached and you start down the other side, people have fear of losing their shirts or losing a significant part of their speculation. And so the third emotion is panic, and it operates on both sides. So people panic when things are going up and they go, I got to get in, I'm going to miss that. And when things are going down, they panic on the other side. So you need to remove those three emotions from the equation completely. If you're trading with emotion, you're not making good trade.